Real estate is priced far beyond what the majority of people can afford. There's simply no way to ignore this fact. This goes for most big cities around the world, and despite the claim that the economy is doing well, there is considerable growth, and that this will continue for the next couple years, it seems that people literally can't make their payments and have gone further into debt than ever before. But I guess everything is fine, right? You came here for the truth, so let me unveil that for you. Today we are going to look at real estate. I want to touch on the US and Canada, but I know that if you live in a major city around the world, you're probably seeing the same exact things. So let's begin by taking a look at this. The Case-Shiller 20-city composite home price year over year. We are back into levels at the end of 2016. That's right, a significant decline right here today. As you could see throughout 2018, everything has really changed. It's not just US equities that have recently come down. It's not just emerging market equities. It's not one asset or another. It seems that everything is starting to fall together, and that here is represented in the Case-Shiller 20-city home price year over year. But I got some others to show you as well. This is the Case-Shiller 20-city comp monthly change, and you'll see that although it's not the first time in this cycle that this has occurred, we have significant declines going on right now. Okay, we're looking at this to be a continued trend, and it has been this way throughout 2018. If it keeps going like this, and we have the, of course, rising interest rates, that's going to put more pressure, and that's something that I want to get to today. This is the most important factor, one which largely the individuals in the real estate industry will not ever talk about, and that is the fact that as these interest rates are increasing, it's putting a further burden on those who are trying to make the payments. I want to cover that more in just a second, but I've got some other charts to show you. The Case-Shiller home price year over year, that's the black line, and the 30-year mortgage rate on the inverse. And it seems to be very correlated. It's interesting the way that this works. So will this be the case? Will the 30-year mortgage rate push down home prices? Will the cost of borrowing money becoming more and more expensive be an obvious, to me, real sign of a slowing down? The more expensive it is, the slower it's going to be. That doesn't take a genius to figure out. 1 year price change percentage by metro area, July and August of 2018. All right. So I'd love to see some more recent numbers, and I will get you those as soon as I can. But we're looking at this. All right. So the orange squares and the orange lines here, I should say, and is July, and the blue is August. So you'll see that in the case of Las Vegas. This has been one of those areas that has been just unbelievable in price appreciation over the last few years especially. So we're looking at this right now. It had accelerated even further, but look at some of these places like Seattle that has seen a huge decrease from July into August. Okay, so that is still, let's be very clear, the prices are still astronomical. They're still selling. But things are changing. In fact, in a lot of these, you can see that the orange line, July, is longer than August. And that tells us basically the prices. Not for every area, like look at Tampa, for example, where the prices have increased a bit further, and Las Vegas just slightly. But Seattle is one of the big ones, and I want to talk about that in a second here. The Case-Shiller Seattle Home Price Index. The last time, I should point this out first, you can see it's coming down. All right. The last time this happened, it was the financial crisis, the housing crisis. Does that mean necessarily that because it came down, that it can't go back up? Of course not. It could do so. It could do so 100 times in a row. But what I'm seeing here is that this happens to be yet another indicator pushing us back into this time frame of the financial crisis. We have to look at that and think to ourselves, what does this mean for the future of real estate when even one of the hottest markets in the United States, Seattle, is actually starting to turn around? Does that mean that there aren't enough buyers? Does it mean that mortgage rates are too high? Does it mean that jobs are leaving? Is the economy not doing well? Is there an oversupply of homes? All of these questions need to be answered, and you could not base your decision on looking at the home price index alone. That's why I always try to really emphasize for everybody to not be so one-sided, to not be so nearsighted. We have to zoom out, as I like to call it, and get as many details as possible. I'm always trying to do that, and I know if you're a regular subscriber here, you also agree with me that we can't just look at one fact, we have to look at them all. And we piece it together for ourselves. We don't listen to other people. We make that decision for ourselves. Home builder stocks, that's the green line here, have simply hemorrhaged in 2018. You'll see what has happened. Yes, in October, they have performed even worse. But looking at this throughout 2018, we're going back into levels. This chart only goes back from June of 2017 and is lower than that today. So home builder stocks are taking a beating right here, along with all other equities, emerging markets, US, and so on. I mean, we can see Amazon stock right now, for example, is down 25% from its peak the last time I checked. 25% from its peak. And yet, still, everything's fine. Don't worry. Nothing to see here, folks. Nothing to see here. I've heard that one many times before. I'm not necessarily saying anything, but something's going on. Now, this is the big news. The Bank of Canada's interest rate hikes over the past 15 months will add more than $2,500 in costs to the average Canadian household, though it may take years for some households to feel the full effect. And the reason is that in Canada, the most common term for your mortgage is 5 years. Okay, so after a 5-year period, you then have to renegotiate the terms. Okay, because the 5-year tends to be the sweet spot for prices if you want to get the best rates. Over the past 10 years, Canadian debt holders haven't had much reason to fret about interest rates, but they may now. That's not me. That's not the Money GPS. That's coming right here out of the Huffington Post article. While higher rates are an indicator of a healthy economy, Canadians with mortgage and non-mortgage debt are starting to feel the pinch. All right? Very, very crucial to understand the amount that people have borrowed. Let's say $500,000. Okay? They've borrowed $500,000, but how will that debt be serviced? Will it be serviced with a loan that's 3%? Or will it be 4%? Or will it be 5%? When you add a percent onto these large numbers like $500,000 mortgages, $1 million mortgages, 1% really does make a big difference. And it has been said, and I've quoted this number many times, I've shown you the different articles along with it, that a $200 per month increase in an individual's payments would bankrupt them. They would have to go into debt. They would have to borrow money in order to pay. That is very worrisome, especially because they're discussing the fact that $2,500 in cost, that's about $200 a month, is now where we're at today. And the Bank of Canada, they've increased, I believe, if memory serves correctly, to 1.75%. We're not even at 2% yet. And already it's breaking people's backs. What is going on? Nobody can afford simple payments anymore. And that's because the amount that they owe, that $500,000, that $1 million, is simply way too much. Why are they allowing the bubbles to be fueled this large? If you had any sense, if you were a central banker, you would have increased the interest rates a long time ago. You would have never have brought them down to record levels like this. You would actually allow people to fail, allow businesses to fail, so that reality can be restored. But if you don't do that, we're living in a fairy tale land, and I have to start every video with once upon a time. If everybody wants that, maybe I should do so. But I think if you're a regular subscriber here, you're probably not into that. You're probably into the truth. The debt to income ratio and the interest to income ratio of Canadian households. All right. So I wanted to focus simply on this line right here. Debt, the amount of debt that people owe today is astronomical. And I have to think that this is an old chart because it's showing us 2017 on here. I don't know if that includes further beyond that, the 2018 numbers, but I've seen it upwards of 175%, if I'm not mistaken. I think it was 178%. But I've definitely shown you here on the channel before. But the point here, I'm just using this as a prop, essentially to talk about the fact that you can base the amount of debt that people have. And you could say, wow, $500,000 for a mortgage, that's a lot. But to somebody else who's in, let's say, San Francisco, oh, you only have a $500,000 mortgage, that's great. So it depends where you live, depends how much you earn. There are so many factors. Depends on the currency that you're in. Canadian dollar obviously worth less than the US dollar. All right, now maybe we're in somewhere in Germany. All right, we got the euro. That's different currency, okay? So different currencies, different areas, big cities, small cities, all of this needs to be factored in. But when I look at the debt to income ratio, that's giving me another very powerful layer of knowledge. And we can see that this number keeps on increasing. And with mortgage rates going higher, that's going to be a big problem. Last but not least, real estate prices may be showing signs of easing, but Canada's housing market remains highly vulnerable. And despite the fact that we have had this easing that's taken place since April of 2017 approximately in Canada, the vulnerability, because the amount of debt that people borrowed up until this time is literally at a record high, you're going to be screwed. The next time you have to refinance your property, look out. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. That's all you gotta do is click that button. Click that button to support this channel. Comment on this video. If you're unsure what to comment, type the words real estate, type housing, type Canada, type whatever you want to write. Just put it below. You're supporting this channel. And of course, you want to join over 150,000 like-minded individuals. You hit that subscribe button. I do videos every single day, oftentimes twice a day. And I want to see you on here. I want to say hello to each and every one of you. And last but not least, if you want the financial education you were not taught in school, well then, these two books have this all you need from A to Z. Check it out, link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.